Hi, I'm Phil Thompson. Thanks for joining me for Phil's Finance Fix. Today is the 9th video in our shares versus property series, and I'm going to be talking about the bias around each asset. Australians have a love affair with property, and there's a natural bias towards property as an investment for a few reasons. Firstly, you don't need to walk too far to find someone who can tell you that they purchased their first home for it to be worth twice as much 10 years later. Second, the average investor feels like they know property as an investment because they can see it, feel it, and touch it. As compared to investing in shares, it's on a sheet of paper or on a computer screen. And the last reason there is a bias towards investment property, and excuse me for putting my conspiracy theory hat on for a little bit, but it is the money. What do I mean by money? Well, simply put, there is a lot more money to be made from banks, finance professionals, media, and the government promoting the benefits of investing in property over investing in shares directly. Commonwealth Bank is a perfect way to demonstrate the difference for a bank to push property over shares, as they have a stockbroking business, funds management business, and a lending business. So I had a look at CommBank's annual reports for 2014, and although it doesn't give me a perfect wrapped description of exactly how much they make on each investment, I was able to gather some interesting information. CommBank made $8.6 billion total profit, and almost 40% of the profit was made from retail banking, which is a fancy way of saying that they made a crap load of money off residential lending. Some might say, well, that doesn't really count because CommBank's main business as a bank is to loan money, and therefore it's okay for most of their money to be through loans, which is totally true. However, if we break it down even further, CommBank's financial statements show that they make 2.14% net interest margin on all retail loans, including personal and business loans. While compare this to the income they receive on the money invested within their own managed funds business, it equates to 0.7 to 0.73% of the total amount invested. So for CommBank, if they see you had $100,000 sitting in a savings account and wanted to help you invest your money, they could recommend that you take out a $400,000 loan and buy an investment property worth $500,000, of which they would make over $8.5 grand in income per year going off their own financial statements, presuming you're doing interest only. Or they could help you invest this money by recommending that you invest $100,000 into their own managed fund, and they would earn between $700 and $730 per year managing your investments. Let's say you're the marketing manager at CommBank. What would you be advertising people can invest into, property or shares? My next target is the media. And when I say media, I'm talking about the direct revenue towards some of our biggest and most influential media companies. There is a report produced by IBISWorld stating that the residential real estate advertising business was worth a combined $730 million in 2014. And the two biggest players are Domain.com.au, which is wholly owned by Fairfax Media, and Realestate.com.au, which is majority owned by, you guessed it, News Corp Limited. So I'm not saying in any way, shape or form that money can get in the way of editorial integrity. However, Fairfax 2014 annual report opens with their chairman Robert Corbett stating that, I quote, "Although print revenue was declining, these declines were almost completely offset by the revenue in Domain, which was up 40%. And considering that the overall digital revenue only increased by 5%, Domain.com.au is vitally important to Fairfax." And also to touch on, Realestate.com.au made a net profit of just under $150 million in 2014. And now to address the skeptics out there saying, how does increased prices affect the media? Well, RP data also shows that there is a direct correlation between property growth and the numbers of sales, meaning that high return on property, the more listings, and therefore the more advertising dollars. Next up is governments. Governments make very little direct income from the purchasing and selling of shares, other than capital gains tax. They do, however, make a substantial amount of money from the transfer of property. The Victorian state budget estimates they will receive $4.44 billion in the 2014-15 financial year, which works out to be just under 25% of total tax revenues. And as the stamp duty revenue is based off the number of transactions and the value of the property, it would be a significant blow to the state budget if property markets was to go flat or if it was to decline. Last but not least are finance professionals, those darn finance professionals. It's important when you get advice to understand how each professional is being paid, asking questions such as, is your business focused on investing in property, investing in shares, or investing in the most appropriate asset for me. And it doesn't mean that if they're focused on investing in property or shares alone, that their advice is inherently wrong, bad, or biased. It's just important for you to understand that they're business so that you can understand their advice. Thanks for watching, and I hope that you can watch next week's final episode on what I think is the best investment between the two. If you have any questions, please feel free to contact me, as my details are in the description below or using the comment section below. And I'd love you to subscribe to the channel as it really helps us out. Thanks again for watching, and I'll see you next week.